Hi, my name's Katie, and I've worked at the cash room for 4 years. I have a lot of experience with cashiering and being a senior legal cashier. I've worked closely with the ILFM and the SRA for many years, and I've been a legal cashier myself for a good 16, 17 years now. And today I'm going to be talking to you about the new 2019 rules for the SRA and how they are affecting firms, significant changes within those rules, other key changes, and some common breaches and mistakes made within the SRA Accounting Rules 2019. Okay, so let's get started. So, how are the new 2019 rules affecting law firms? The account rule changes came into effect on the 25th of November 2019, and these new reforms were approved by the Legal Services Board and a part of their Looking to the Future programme, allowing solicitors to have a greater flexibility in how they work. The new rules are designed to be far more outcome focused and are shorter and more targeted than existing rules. They continue to focus on the protection of client money, but with the freedom for solicitors to use their own professional judgment when considering how standards are met, by applying simpler accounting rules that focus on the principles of safeguarding client money rather than lots of specific technical rules, which were in the more like the old rules. Under the old rules of 2011, period controls are specifically described. For example, when transferring costs, you had 14 days to do the transfer, and when banking monies, it was specifically described as the next working day. However, under the 2019 rules, these period controls have been removed and have now been replaced with the word promptly, leaving it open for you as a firm to decide what promptly means to you. The significant changes to these rules, there are two in my recommendations that are more significant in these rule changes. The first one being the fact that you now can only transfer funds from client to office account when a notification of costs has been made to a client. This may mean a bill has been provided to the client or an other written notification of costs. Perhaps a completion statement could be considered a written notification of costs, or a letter or an email to the client. This means that under the new rule 4.3, firms have to have this written notification or bill before you can physically move the money. And under the new rules, disbursements are now considered within the definition of costs, which means you do need to bill or provide the client with a written notification of those disbursements before you can do the transfer. Obviously, this is a quite significant change for a lot of firms where client to office transfers for disbursements are quite a regular occurrence, particularly if you're receiving money on account for disbursements. So you do explain to the client that's what it's for. However, I believe you now need to specifically say what the notifications of costs is. So what are those individual disbursements before you can move the money from client to office. The key changes to the rules. Obviously, as many of you will be aware, the number of the rules has been reduced significantly to 13 compared to the old 52. Changes have been made in what is classed as client money. This means some firms may no longer need to hold a client bank account. Under Rule 2.2, you can now receive money in advance for fees and disbursements into office account, providing that is what the money is for, fees and disbursements, without the need to hold a client account. So firms who don't receive client money for client specific transactions in and out and only receive money in client account for fees and disbursements should consider removing the need to hold a client account, because it will mean a reduction in the rules that you need to abide by. So it's certainly a consideration to be made for many firms. Obviously, money received from the legal aid agency as well has changed under the new rules and is now classed firmly as office money. This includes the money for legal aid disbursements. Professional disbursements were considered separately to disbursements in the old rules. However, it appears all disbursements were treated in the same way under the new rules. So any professional disbursements, any normal disbursements are all classed as client money until you provide a written notification of costs or a bill to your client, at which point it's classed as office money and you can then do a transfer from client to office. Agreed fees are no longer considered as separate to costs. Under the new rules, agreed fees are classed as client money until the bill is raised, unless the firm follows the changes in Rule 2.2, in which case you're holding only an office account and no client account. The new rules now formally require the COFA or a manager of the firm to review and sign off the client account reconciliations, and spells out that any differences in the reconciliation should be investigated and resolved promptly. The word promptly is suggested in a lot of these rules, and I'll talk a little bit more about that in a second. Rule 10.1 states that firms running client's own account will now be subject to reconciliations every 5 weeks. The SRA understand that not all law firms will keep ledgers for a client's own account and will not necessarily have access to monthly bank statements in order for reconciliations to be carried out at least every 5 weeks. So if you are unable to meet these requirements, you will not be regarded as being in breach, providing that you satisfy yourself that the client money is not at risk and record the position. So the SRA do expect you to keep a central register of the client's own account that you operate, a separate record of the transactions carried out by you on your behalf in respect of that client's own account, and a record of the bills and other notification of costs relating to the client's matter. The information must always be available to provide to your reporting accountant in order to ensure you abide by that Rule 10.1. New Rule 11 specifically refers to the use of TPMA, third-party managed account. This means you are permitted to enter an arrangement with your client to the use of a TPMA. You, however, must still ensure to obtain regular statements from the TPA provider and ensure these are accurately reflected on transactions on the account and are reconciled, so that your obligation to record these transactions and reconcile them still remains even if you are using a TPMA account. In relation to the new rules, we recommend that you have a policy in place defining the meaning of the word promptly. Promptly is named in quite a number of the new rules, at least 4 or 5 times. And you cannot have, well, we recommend you do not have a blanket response for what promptly means to you, or a blanket definition of what promptly means to you as a firm. Now the rules are more outcome focused. They're looking at trying to put the emphasis back on the firm. It's up to you as a firm to decide what promptly means to you. So you can decide in each rule what your acceptance is, what promptly means. So I definitely recommend having a policy which specifically states what promptly means in each rule, define each rule, say the rule number and what promptly means in that rule number to you as a firm. I'd also recommend that you talk about why you've chosen to go down that route, why you've picked those number of days or the time scales that you have. That will enable you to give that to your reporting accountant for your audit. And it will also ensure that everybody in the firm has the same understanding of promptly. So you need to ensure that your cashiers, your accounts department, your fee earners, your secretaries, everybody who is dealing with client money on a daily basis knows what promptly means in each of these rules. So they know they are abiding by the firm's own rules and regulations in respect of the word promptly. So it is important that that message is provided to everybody in the firm, and anyone new starting would need to know that promptly to you is different to where they may have worked previously. So it's important that you come up with a process, a policy, a procedure for the meaning of the word promptly in each of the rules mentioned. Now I'm going to talk a little bit about common breaches and mistakes with SRA accounting rules. As part of my job at the cash room, I've seen a lot of unfortunate breaches, errors, mistakes made for people not realizing that it will be a breach of the rules or not taking enough care and attention before they try and do something. So it's really important to try and capture these common breaches and mistakes and stop them from happening as much as you can. So the first one is drawing money from the client account for all payments, including transfers on behalf of the client when the client's written authority is needed, and transferring to office account only on the notification of costs. So this is what I spoke about earlier, account rule 4.3 and 5.1. If funds are transferred between clients without the client's written authority, this is a breach. So for an example, if I'm selling my flat and buying a house with my partner, myself as an individual is considered to be a separate client from my partner, and myself as part of a couple. So my written authority is required to transfer the proceeds from my sale of my flat to the purchase of our house as a couple. Okay. So you must ensure that you receive my written authority to transfer the money from the sale of my property to the purchase of our property. Okay. In order to ensure that you avoid breaches in this way, we recommend that you put a procedure in place to ensure confirmation that the mandate given the client's written authority for a transfer to another client file is obtained and has the appropriate approvals in instruction to the cashiers when transferring the funds. So if I don't try and make that a little bit more make more sense, if you have a mandate from the client and client's written authority as a fee earner, you may then want to pass that to an appropriate assignee, which may be a partner or a director or a head of department, to confirm the client-to-client can take place between two different clients. Then when the cashier receives it, they take the appropriate approval internally that this can actually be done because we have client's authority. I also recommend that you put a procedure in place to ensure confirmation that a bill or written notification of costs has been issued before you do a transfer request. So if you're transferring between client and office account, your cashier may not necessarily know that you've done a written notification of costs. They will know you've done a bill because there should be a bill on the file. So if it's to do with a written notification of costs, you should have a policy or procedure in place whereby your fee earner or your secretaries or your paralegals or whoever is creating the request for the cashier to let them know, yes, we can now move this money, is declaring that they have received written notification provided written notification of costs to the client initially. Okay, number 2, the withdrawal of funds from a ledger where the current balance held for that client is lower than the actioned withdrawal. This is a client account, must not be overdrawn. This is in relation to accounts rule 5.1. You will be surprised how many of these we see. It's very it should never occur. There should always be enough money in client account to make a withdrawal from that client matter. You must ensure that before any payment is made or requested against a client account, that there is enough funds showing on the client side of the financial ledger to cover that withdrawal. If there are not sufficient funds on the client ledger, you must not make that payment. Best advice I can give on this one is to ensure that anyone who is requesting a payment from client account checks the ledgers, looks to see the payment, how much money is on the ledger before you physically make a payment from client account. You would think this was an obvious rule and an obvious comment to make, but you'll be surprised how many times I've seen it happen. So please make sure you do check your client ledgers before you request withdrawal out of client account or make a withdrawal if you're the person actually doing the payments and posting and everything and requesting, then please make sure that you've checked and there is enough money to make that withdrawal before you do it. That includes the movement between client and office account. Please check you actually have enough money to move your costs before you move your costs. There could have been a calculation error on the file where you don't hold as much as you think you do. So please check that what you think is in client account is in client account before you request a transfer of money from client to office or a withdrawal. Number 3 is the improper use of client account as a banking facility. This is rule 3.3. This is a warning notice as well provided by the SRA recently. So I think they have some major concerns over improper use of a client account. And this could also have some considerations for money laundering as well. So it's one of the most called out issues at the moment, I think, is the improper use of a client account as a banking facility. Payments into and transfers or withdrawals from a client account must be in respect of the delivery by you of regulated service. Okay, regulated service means the legal and other professional service that you provide that is regulated by the SRA and includes, where appropriate, acting as a trustee or a holder of a specified office or appointment. So Rule 3.3 reflects decisions of the Solicitor's Disciplinary Tribunal, that it is not a proper part of a solicitor's everyday business or practice to operate a banking facility for third parties, whether they are clients or not. Okay, so you must therefore, if you receive funds in your client account, whereas there is a proper connection between the receipt of the funds and the delivery by you of regulated services, you must only receive the funds in that circumstance. Sorry, I said that at the start. So just to clarify, you must only receive funds into your client account where there is a proper connection between the receipt of the funds and the delivery by you of regulated services. It is not sufficient that there is simply an underlying transaction if you're not providing any regulated services, or if the handling of money has no proper connection to that service. There must also be a proper connection between the delivery by you of regulated services and the payments you are asked to make or receive. Here's some factors you should bear in mind when considering these issues. Throughout the retainer, you should question why you're being asked to receive funds or for what purpose. The further the details of the transaction are from the norm or from the usual legal or professional services the solicitor provides, the higher the risk of breaching Rule 3.3. You should always ask why you're being asked to make a payment or why the client cannot make or receive the payment directly themselves. The client's convenience is not a legitimate reason, nor is having access to the bank account, not having access to a bank account in the UK. Risk factors could include the payment of substantial sums to others, including family members or corporate entities, particularly overseas, if there's no reason why the client could not receive the money into their own account and transfer it from there. You should always consider money laundering obligations and regulations in the receipt and transfer of money. You have a separate obligation to return client money to the client or third party promptly as soon as there's no longer any proper reason for you to hold those funds in relation to Rule 2.5. And speaking of Rule 2.5, that is my next common mistake and breach. So Rule 2.5 is client balances held after the conclusion of the matter should be dealt with promptly. So this is in replace of the old rule, which referred to residual client balances and had a lot of details and information about the dealing of a balance after the conclusion of a case. In the new rules, any balance held after conclusion of the matter is a breach, unless there's any real reasons to hold those funds. In order to avoid this breach, I would suggest you review the guidance provided by the SRA on this new rule. It is actually more or less in line with the old guidance, with the old rule. If the balance is over 500, you should still seek approval from the SRA to withdraw the money to a charity or other. You should still really seek an indemnity from any charity that you're sending balances to where the client could not be located or identified. There are two advice options that I would provide to you. First one is ensure that everybody, all fee earners, are reviewing their balances when they're receiving your month-end reports. So part of your month-end reports, you should always receive a matter balance list, and if necessary, that be broken down into fee earner, and those fee earners should be checking their matter balances for any leftover balances for closed or coming to be closed files or finalized matters. And they should be investigating why they have a balance and ensuring that money is dealt with ASAP. And that should be done on a regular process, a policy in the firm to say this needs to be done every 5 weeks, 4 weeks, month end. Totally up to you on the process, but I would recommend no longer than a month, really. I also recommend that you obtain client bank details when you open a case. So when you open a new case, that you obtain those client bank details so that any money at the end of the case can be returned to the client by bank transfer. This will prevent uncashed checks, which is one of the biggest culprits of why we have residual client balances in solicitors' firms. Checks go, they don't get drawn within 6 to 12 months. And then 6 to 12 months later, we maybe raise a second check. And again, that doesn't get drawn within 6 to 12 months. And then we're suddenly 2 years down the line or a year down the line with 2 checks gone, not cashed. And we can't find the client. The client's moved on. We can't locate them. They're not answering any telephone contact details that we have for them or email details. And therefore we cannot return the money to the client, and then it becomes a problem trying to identify the client. The balance is considered significant. You're then having to look at investigation options. If you had the client's bank details up front, you could bypass all this issue by just removing the need to send checks. If you send the money out by BACS, it automatically goes into their account, and you have no balance left. The problem is solved. So absolutely, as much as you possibly can, make it part of your client opening procedure to receive client bank details at the start of a case. Okay, and last but not least, the completion of a 3-way client reconciliation every 5 weeks for all client accounts held or operated by you, which now needs to be signed off by a COFA or a manager of the firm. When we say a 3-way reconciliation, what we are actually talking about here is a reconciliation between your bank statement, your cash book or client trial balance, and your matter balance listing. This is why we say 3-way. So you should have we do recommend that you use this as part of your month-end routine, and you do this at each month end because it's the easiest way to ensure that you stick within the 5-week rule. So each month end, you take those 3 balances and you reconcile them against each other, and then that report, along with the month end reports underneath, is provided to the COFA or a manager of the firm to be signed off and then held electronically or in paper. I would prefer electronically, as would a lot of firms nowadays, and it's probably the best way to go. Save that electronically so that when your auditors come in, you can show them, here's a file, here's June, July, August, September, here's all the signed reconciliations, which include the 3-way reconciliation. There are a lot of systems out there right now that do the 3-way reconciliation on the bank rec itself, which means it does it for you, which is fantastic. Not all systems do this, however, so you cannot take what the system is showing you as a 3-way rec. That might not necessarily be the case. It's always good to check that your matter balance report and your client trial balance agrees with your bank reconciliation report. Okay, do remember that goes for all client accounts held by you. This is not just for your main general client account. you should have this three-way reconciliation for all the accounts that are classed as a client account, deposit account. Okay. And it is better to have a report which highlights each of these on that one front page. It's like a front page of all your month-end reports. So ideally, that's where you want to get to. And I would recommend that it calls out any identified breaches as well. So did it notify any office credits or client debits when you ran your month-end? And you can pull it up in that first page. I hope this has gone some way into helping you understand the new rules and also capture any common areas of errors or mistakes that can be made in the solicitors accounts rules. Obviously, the new solicitors accounts rules are very outcome focused, so they are based on, you know, if you've managed to remedy your breach, it may no longer be considered a breach because you've remedied it, and therefore the outcome is what it was expected to be from the start. I would still recommend that you record the potential breach and the, you know, the remedy that you put in place or to fix it. So you have what could be considered as an error log rather than on the breach register. But again, that's up to your COFA to decide and look at. But I do hope this has helped, and it's been lovely to speak to you all today. Thank you.